This particular market economic event that's about to happen, and I think a lot of it's going to occur between now and the year end in terms of price drama in certain markets. Dollar index, for example, perhaps a panic in the T-bond market that causes the central bank to wet themselves. Stock market suddenly, the new high didn't hold. What's going on here? Things like that. Commercial real estate. Company did what? These type of events aren't like we were in the late 70s or the gold bull move that went to 2000, in 2011 and 1900. The stock market drop in 2008 and 9. This is different. I think this is going to be far more serious. I think the wave effects will hit reality, people in the street, so to speak, their day-to-day lives, whether they hold stocks or not hold stocks in their retirement accounts.
Across America's commercial real estate landscape, tremors are forming. This isn't about a few homeowners losing their mortgages. Entire sectors, including massive retail complexes and corporate spaces, are under pressure. As stress ripples through these giants, investor sentiment could shift rapidly. Add to that record high consumer debt and fading strength in discretionary spending, and you have a powder keg. Markets may laugh now, but when these failures multiply, emotions will replace optimism in a flash. While investors chase tech hype like Nvidia, a silent structural crisis is brewing beneath the dollar. Since 2023, the dollar index floated in a narrow range, dull on the surface. But beneath that calm, momentum signals have broken down dramatically. If the index closes below key levels like 98.35, it threatens to collapse through a decade-long support zone. This isn't just technical chatter, it could trigger global tremors in forex markets, foreign investment, and US bonds.
It's not little this guy and that guy and they lose their mortgage. We're talking about big companies and a weighty sector. When you look at it and compare it to an S&P chart, you chuckle. Okay, it's too significant to ignore. And this obviously, if something happens there in multiples instead of like that one shopping center complex, a large one, you suddenly hear another one and another one. Then attention's going to shift and emotions will shift too, because the people will be ambushed by events they didn't expect. Everybody thinks that all that matters is Nvidia. Okay. Actually, if you look at an Nvidia chart, it's a boring situation. We're at 55 plus right now, new highs. Okay. But go back a couple of years and you're not making much money. It's really been a clump of ink and you're poking out above the high a little bit. Other things have been making money. But the other factors could come into play, and we think one of them is the dollar. Not just the long bond rates staying high and choking. And by the way, I think the bonds could have an implosion of sorts. Right now we're 114 area on the T-bond futures. You don't want to see them get down into 110s again. If you do, you might get a mini panic in the government bond market. That's something the Fed will panic over. It may not be one of their mandates, but they'll panic. We've been watching the dollar over, it's one of the categories we watch. But if you'll look at what's happened to the dollar index now, I'm not talking about the dollar's real value. That's constantly decaying, just like the euro and the yen. It's just competitive decay, okay, in real value. But when you measure the dollar versus the euro and the yen, which is the dollar index, they constitute 71% of the dollar index. You've had a boring situation from 2023 through 2024 and in much of this year, where the price was stuck in about an 8% range of price action, up and down, but nothing really dynamic and no real trend, just oscillating sideways. In March of this year, when we were coming down off of a rally high at 104.21, we closed that month. We said, that's it, major bearish on the dollar index now. Price chart has a level at 100 that seemed to matter to the price guys, but we were breaking that. We're still 104 at that time. But we saw on annual momentum a massive structural breakage of a trend that goes back well more than a decade. So momentum said, hey, you're broken. Now, even price right now, if you draw price channels on the dollar index, you can see we're challenging a price channel that goes back a decade plus. But if we close out this month or any month this year below 98.35, and right now as we speak, it's 97 something, okay? You're going to blow a 10-year average momentum structure that's even worse than the 3-year average structure, saying you're broken so big, it's the biggest you can break. And I would think the dollar could start to implode down to where it's been in decades before, in the 70s. That in itself would be a major upset, because then the quiet one, the major Forex markets, which have been dull quiet, 23, 24, suddenly become a volatile factor affecting other investment areas. Technically broke at 104, so 7 points above here, we said, that's it, it's over. We've got a secondary breakage level, which we're now below as well, with a day left in the month. And if you don't close back above it, 98.35, and it's unlikely, you break further structure, which I think this time will generate far more than just single percent change. I think it could get you moving in a more volatile manner, which creates a factor that wasn't a factor for the last couple of years because it was so dull. It wasn't moving much. If you're a foreign investor, and we understand that foreign investment in the U.S. stock market is now at the highest it's ever been for the last couple of years, you're impacted by a downward shift in the dollar. Because, you take your euros and yen and you buy U.S. stocks and dollars. Okay, so you not only care about the U.S. stocks, but the dollar. And you just got kicked already. Even though the S&P is back to its highs, your investment is not back to its highs in your currency terms. And if you start dropping more precipitously, that could also affect what? Foreign owners of U.S. government bonds. So it's a factor that could come into play, and I don't hear it as being talked about much, which is fine. That's the way you want it, because that's how ambushes occur.
The Treasury bond market is nearing a breaking point. If yields spike further and futures dip toward 110, a panic may grip the Fed even if it's not part of their official mandate. Meanwhile, commodities, long dormant, are signaling a new uptrend. This combination could upend Powell's strategy. If one more Fed governor calls for cuts, pressure will mount fast. Lagging data might catch up too late, leaving the Fed flat-footed as multiple crises converge at once. What's coming may rival or exceed the crashes of 2008 or the inflation of the 1970s. But this time, the consequences might hit harder and reshape daily life. The faith in fiat currencies could erode, with gold-backed alternatives gaining traction globally. For now, markets may smile at S&P highs, but rising defaults, collapsing real estate, and a weakening dollar suggest a deeper shift. When central banks panic, reality for the average investor and citizen could change forever.
It's one of the components, but it's a lesser component of the dollar. It's down like 7 or 8% or something of the dollar index. But yeah, it's anyway. That's another factor out there. That, there are 4 categories, and one of them was asleep. Now suddenly it's waking up, and there's no headlines yet. Wait a second. Maybe there will be. Also, look at the debt, as you mentioned, consumer debt. Why is consumer discretionary so anemic? That used to be one of the front runners. Amazon, for example, is like 20% of that EPF, and a lot of names you would know. And suddenly, they're not making new highs. What's wrong? What's wrong with the consumer? I thought everything is fine. And there's another ambush coming too. The other ambush is commodities are going to turn up. And I don't mean war news buying of oil, which is a mistake for anybody who bought oil in war news. But I'm talking about in general, the commodity category looks primed for a major next upwave, which would upset all kinds of assumptions, as we know. I don't know. I haven't looked at the last couple reports. There's one coming up in a week, but one of the factors that kept it bloated was government hiring. Now, that may have changed too recently, but it's a lagged indicator. In other words, if you go back to 2000 or 2007 and look for unemployment as a signal to sell, no, stock market told you first. In other words, if this new high in the S&P is what we argue it is, a trap, and suddenly you begin to unwind back down again, and I'll give you a number. You don't want to see 5,700 again. Okay, now we got to 4,800. I'm saying we're now, above 6. You don't want to see 5,700 next quarter. Okay, that would be a solid sign that the whole high was a fake out. And by the way, if you're a price guy, and the data points will follow the market. That's what the point I'm making. So the data points that Powell likes to look at, they're going to smack him in the face, and he's going to look kind of stupid because they do lag the market. They never lead. Now he's going to have another problem if just one more Fed governor crosses the line, because he had one that said, no, we need to cut now. And then suddenly there's two, need to cut now. You get a third one, it starts to become a chorus. And then suddenly he looks reluctant. For what reason? Are these three people stupid? Or is he doing it for another reason? Anyway, he's got a political problem if he loses like one more Fed governor. And the data points will follow and vindicate cutting rates. They'll get what they need. But then there's the other factor I said, that T-bond market, watch it. And watch the dollar, because those aren't on the mandate list. But they will have an impact on things that do affect the data points. And that's when suddenly heads will turn quickly and late. Don't care. I frankly have said that this particular market economic event that's about to happen, and I think a lot of it's going to occur between now and the year end in terms of price drama in certain markets. Dollar index, for example, perhaps a panic in the T-bond market that causes the central bank to wet themselves. Stock market suddenly, the new high didn't hold. What's going on here? Things like that. Commercial real estate. Company did what? These type of events aren't like we were in the late 70s or the gold bull move that went to 2000, in 2011 and 1900. The stock market drop in 2008 and 9. This is different. I think this is going to be far more serious. I think the wave effects will hit reality, people in the street, so to speak, their day-to-day lives, whether they hold stocks or not hold stocks in their retirement accounts. This particular market economic event that's about to happen, and I think a lot of it's going to occur between now and the year end in terms of price drama in certain markets. Dollar index, for example, perhaps a panic in the T-bond market that causes the central bank to wet themselves. Stock market suddenly, the new high didn't hold. What's going on here? Things like that. Commercial real estate. Company did what? These type of events aren't like we were in the late 70s or the gold bull move that went to 2000, in 2011 and 1900. The stock market drop in 2008 and 9. This is different. I think this is going to be far more serious. I think the wave effects will hit reality, people in the street, so to speak, their day-to-day lives, whether they hold stocks or not hold stocks in their retirement accounts, caused by monetary booms and busts, which lead to stock market booms and busts, hasn't been working. They're always too late, or they always cause something. How about we just have a currency that's real? You can't inflate it overnight because you want to. I suspect a lot of these kind of things will happen. I'm not advocating or predicting. I'm just saying this is different this time. So don't expect gold to go up to a certain level and have a major bear market. This time, I think you might go up to a certain level, wherever that may be, and it's not anywhere near here, and it's institutionalized. So it's a different reality we're dealing with, I think.